Good morning, everybody. After listening to Winston and the power of the ST algo, I think you don't need guys like me anymore. We do a lot of manual data compilation, and what we do is we drill down from the top. We can talk about the market from the top and also from the market from the bottom. I think the ST algo is very powerful when you talk about the micro-locational factors, where you want to search for your property, not only for agents, but also for the end user and buyer, or people who want to rent the properties. But for the sake of for today's presentation, I'll look at it from the top-down approach. Well, I've got 30 minutes, some slides to go through. So I'll start without further ado. So now I'll give you a rundown based on these 8 points, right, from point 1 to the last point, outlook of the Singapore private residential property market. I'm not talking about HDB, which Eugene will be talking about, and I won't be referring to executive condominiums, only pure private properties. So the economic indicators have been showing that the Singapore economy has slowed down after the recovery from the global financial crisis. And population-wise, we are, well, as of 2013 end June, it stood at 5.4 million. And back then, it was said that the increase was 1.6%, slowest in many, many years, almost a decade. It's been, previously it's been growing like 2%, 2.5% per annum. But suffice to say, even at 1.6% per annum, we grow at that rate from 5.4 million. Before the year 2030, our population will be 6.8 million. So I think, all these concerns that some members of the public have been throwing up on the website that, population will go to 10 million or etc. We should interpret that with a time frame. You're not talking about in a span of 20 years or 30 years. We're talking about in a long term, 50, 60, 100 years. Right? If you're 100 years, 200 years, maybe the population can be 50 million. We don't know, provided mankind doesn't wipe itself out. So we look at how some of these property measures, I won't list down all of them, but I would say is this, that if you look at the superimposed, or you place the dots, each of these dots represent a measure. The blue dot are measures that are good for the market. The red dots are measures that are so-called meant to suppress the market, either through taxation or through means like controlling the loan-to-value ratios. From 1981 to the year 2014, by no means exhaustive. Right? There are 21 major measures. Now, 20 of them are measures. The 21st is the TDSR, which is a framework. And the government says it's not a measure, but it is a permanent feature of our banking system now, or the loan credit approval. Of the 21, only 5 are pro-market. So we have to take that in perspective. We look back in history. So what are the odds then that the government will come out with a measure that will help the market? Chances are no. But again, we look at the market. Despite all these measures, the market has been trending up, right? The trend line is clearly up. So the measures have been there to basically tap the brakes to prevent an overspeeding of the property market, price-wise. So we'll move on to the overall sales trend. URA, we follow the URA definition of what you mean by luxury segment, mid-market, and mass market. So the luxury segment, the URA puts it into the core central region, CCR, that comprises districts 1, 2, 4, 9, 10, 11, 4 being Telok Blangah and Sentosa. So in Interlace is under that district 4. RCR will be anything from districts, well, with the exception of, if you see this bar, this black line, right? Those colored in blue, pink, and yellow, that's CCR. Then bounded within that, this black line, right? Clementi Road here, Ang Mo Kio Avenue through here, and then Steel Road here. That's RCR, mid-tier, mid-market segment. Then outside of that will be OCR or mass market segment. So we will be talking about these three segments on the market and how the sales price, sales performances have been for the past year or so. So overall sales trend, before we look at it, we look at the primary sales market. I think for many of us in our industry, the property consultancy or the agencies, who are the larger agencies, we are more concerned with the primary sales because primary sales make up 60–70% of total sales transactions. And what do you mean by primary sales? They refer to developer launches. And if you, in today's market, it is the primary sales market that is driving. In fact, last year, 2012, 2013, and this year, the primary sales market has been driving commissions. And primary sales market in the first half of 2014 has been hit quite severely because of the TDSR framework that was implemented on the 29th of June last year. Right? So you can see that it is clear that it went down, but I also can say that it is not only because of the TDSR, because also another reason is the government has been slowing down its government land sales program for non-EC private property. So the number of government land sales program sites has been coming off. So there are a lot of market watchers, or rather a lot of people who are not in the market don't seem to factor in this, that while there appears to be an increased supply coming on stream, the government has also been toning down on the pure private land sales supply. So that has to be factored in, something that you have to think of moving forward to 2015, 2016, 2017. Right. Sales volume, you can see that has been coming off quite a fair bit. And you can see that in the 2000 and before to 2007, right, this is overall sales volume. Primary sales, as developer sales, sub-sale, and resale. What do you mean by sub-sale? Sub-sale refers to you buy a property from a developer, and before it is completed, you flip it out. That's a sub-sale. But today, because of the SSD, seller stamp duty, sub-sale is likely going to be dying off very soon unless there is a mortgagee sale or forced sale. Prior to 2007, you can find that there is a quite equal mix between CCR, the luxury segment, RCR, the mid-tier, and the OCR. And because of this pattern in the past, the en bloc sales, the collective sales in the CCR was also pretty active, CCR and RCR. Developers then could not be faulted that, hey, if I want to, I should be paying top dollars for something in the Orchard Road District 9, 10, 11 for en bloc redevelopment. And because the sales profile after global financial crisis changed to incorporate mainly this light blue bar, the OCR and the RCR, and the yellow bar, which is the luxury segment, as a percentage of sales volume, changed the other way. So now, why is there this problem with the luxury segment not clearing the market? Is because developers had bought many of these collective sales back in 2005 to 2007, learned the experience and thought that this will be projected forward in 2008, 2009. Then when they came to 2012, 2013, 2014, they tried to launch, they find no takers. The main reason is, prior to the global financial crisis, the world was levering up. Right? You have hedge fund managers earning a couple $100 million a year. You have oil at $150 per barrel. The Arab sheikhs were buying. Middle Eastern money was flowing in. And you bought the luxury segment. But after the GFC basically hit investment banking and hit those who levered up. It's a speculative activity. So the speculative new rich is out of the market, left with the core underlying demand from the traditional buyers like Indonesians. And then the Chinese were there. But the Chinese also started falling after 2010, 2011. And this time around also dropping because we have the TDSR, no, not the TDSR framework. They may pay in cash, but it is because of the ABSD that we feel on the ground. They are pretty turned off by the 15%. They can afford to pay the 15%, but they're not willing to pay that 15%. So money flows out. So property price index-wise, the URA price index has shown a dip since the third quarter of last year. Although there was a dip earlier on in not too long ago, in 2010, 2011, the time, but it is a mild dip. But you can safely say that it's the dip since the global financial crisis is turned down here. It's about 17 quarters exactly, right? Break it down into the three regions. All have shown signs of a bit of moderation and softening. So luxury segment-wise, how has it been performing? Sales volume is very low. Right? New sales only 200 plus. Right? Resale, everything. If you multiply this first half number by another factor 2, but one more time, you probably still see that sales this year is going to be less than the whole of 2013. And price, there's some positive news to it, and that is that it has been holding up pretty well, $2,100 per square feet for new sale. And the others, as far as the others are concerned, the resale market, it is showing signs of softening. Now, I have to warn people that this price is taken off from caveats lodge. Caveats, particularly for new sale, the developer may not necessarily lodge a price net or rebate. So it could have been a gross price before rebate, and possibly that could have kept the price firm up there. Right? But in the sub-sale market, it's also been pretty firm. You can see this light blue line. Right? So, nevertheless, for us, at Savills, we compile a prime non-landed property price basket. And what do I mean by that? It is for apartments that are above $2,600 per square foot and a size of 2,000 square foot and above. That is softening. It has been softening for over a year. Right. To date, it's dropped about 5.6% since the peak in early 2013. So let's take some of these projects that were in the luxury segment that were launched from the start of 2013 to date, to the second quarter of 2014. And we can see that with the exception of Robin Suites and Novena Regency happened to fall in District 10, but it's captured within the CCR, Core Central Region. So if you ignore this Novena Regency and Robin Suites, well, it was launched early before the TDSR framework. But look, the sales volume has been dismal. Some of them are as low as 3%. Right? And even those like Farah that was launched before the TDSR framework, launched in June of last year. And remember, the TDSR came in towards the end of end of June last year. Sales were still very low, right? Because ABSD was there. ABSD of 15% for the foreigners. And moving to list out more projects, right? They are pretty low sales-wise, with the exception of dual residences, which in the market we feel is in a sweet spot, the right spot. No new launch there in the Bugis area. But we also feel that the price was a bit on the sweet spot. In other words, they did not price too aggressively to maintain a moderate sales pace. So sales is pretty strong because the pricing was right at the sweet spot. Many felt that it was a good deal. Other than that, the others have all stuck. RV residences, right? So moving on to the mid-tier, we find again, sales are better than, better than these in the cost in the luxury segment, right? Luxury segment, you have projects at 3%, 5%, 9%, so 12%. So, but going to the mid-tier, you find that sales have generally surpassed 50%. And that's why I said earlier on, it is the different buyers profile. The mid-tier will include areas like Alexander Road. Some Commonwealth Towers is one, right? Echelon, the Crest. These are examples of mid-tier projects. But I have to say that even because of the zoning, the way I cut it, the URA cuts it out, Geylang is also mid-tier. Right? So, but price-wise, you know that Geylang, because of the small format homes, it is pretty high, $1,300, $1,400, $1,500 per square foot. And, right? So sales are pretty strong. Even Corals at Keppel Bay, it's at close to 50% sales. And the price quantum is pretty high. So these are the areas, mid-tier is where the local domestic demand usually focuses on. Right? Starting from the mid-RCR, mid-tier, and also the mass market OCR. Right? So sales are pretty strong. The Creek is because it was launched. Well, okay, sometimes there are projects that are having a recording low sales. But I can say that when you are in a market like us in every day, we don't just use, well, I'm presenting a top-down approach, but we don't usually do a top-down approach when we discuss our marketing strategies with the developers, with our agents. Every project tells its own story. So why sales are so strong for some and why sales are weaker than the others. And in particularly today, where market is, because of all these measures and the TDSR framework, you have to be mindful of the pluses and minuses. You learn from the mistakes that other projects have suffered or been affected. We also take out the strong points. In some of these cases, it tells its own story. But sometimes it's also beyond their control. They could have been launched in an area that has been saturated with previous launches. So what happens is that usually, if you look at Singapore, you data mine, you just do your income household statistics. I would say generally for private property prices, private property demand, the glass is only about half full only. Many people out there, in fact, many of you guys can afford to buy another one. But why aren't you buying? Or there are people not in this conference who aren't buying but they can afford. It's because, number one, they're not interested in buying property. They could be interested in other things, playing shares. They could be interested in going for a vacation. So what happens is that in the project that's launched in a saturated area, coming up, you have the third or fourth project there, the first line of low-hanging fruit, those are serial real estate buyers, right? People who have made money, likes real estate, not interested in shares. They have been basically taken off. But in the past, because you don't have the TDSR, you could be serially buying. Right? So no problem, they will buy 4, 5 properties, 6, but today you can't. So we're left with a layer down there. So many have been led to believe that it is beyond the reach of many Singaporeans. Yes, in number terms, it's very expensive. But in terms of the percentage-wise, there are a lot of Singaporeans out there who can still afford it. Take, for example, you take a 5-kilometer radius around a inverted commas saturated area at Serangoon, which is where Boathouse Residences is, River Sales is. You take a 5-kilometer radius and you draw. You can find that there are about 90,000 households in Singapore earning $6,000 or more. Right. So if you bring down the number households, you lift the 6,000 hurdle to 8,000, 9,000, you still see about 30,000, 40,000 people out there. But how many condos are out there in the market there? Not many. You know. It's a lot. So where there is demand, right? There is not like in other countries where you have faced with a vacancy rate of 30, 40%. Singapore, there is demand. It's just that people needs to be incentivized and motivated to go into the market. And this time around, those who have been serial buyers are kept out of the market. So we're left with people who probably take their own sweet time to buy. So mid-tier price, we find that generally there's also dip in the resale market. Right? Moving on to mass market, the OCR. Transaction volumes follow the same pattern for the RCR, very low. You multiply this by 2, you still be less than last year's numbers. Price-wise, also a little soft I'm focusing more on the resale price index because the new sale happens, as I said earlier on, it captures the, you could potentially have captured the price before the rebate. And transaction volume-wise, transaction sales-wise, been pretty strong. Right? Same like the RCR. Domestic liquidity, domestic demand. Price-wise, it's about 1,000, from about 1,000 to 1,005. Right? But bear this in mind, there's a lot of volatility in the OCR region because the influence of the MRT station has a major impact on pricing. If you are away from the MRT, you could be priced at max 1,000. If you are near the MRT, you get about 20, 30, 40%, even 50% premium up. So at Jurong Gateway, they had about 59% premium, was marketed about close to 1,006 versus a $1,000 per square foot for one that is in the OCR, which is not near the MRT. But with the TDSR, things has compressed a little bit. Maybe now, with the impact of the MRT, for mass market, you'll see pricing about 1,004. Without MRT, I think our belief is that the sweet spot is 950 per square foot. You see that some of these projects that are the NEST with 900 over units that was launched in March this year, it's about 94% sold. Price is $960 per square foot. Right? And Stratum and all those projects, we find that the sweet spot is around there. If you move on to, if you just raise it a little bit for the OCR, if you think the sweet spot is 950, you try to push it to 1,050, you find sales just practically collapse. So it's a very sensitive, price-sensitive market for the OCR region. Very, very price-sensitive. And of course, again, I said every project has its own story to tell. But we can say underlying the OCR market is extremely price-sensitive these days. More price-sensitive than the RCR segment. Okay. So earlier on, I showed a slide on the RCR, and the sales were about about 50% generally. But the OCR, we have some projects, the sales are pretty dismal. And again, I said these projects, some of them were has its own. Everyone has his own story to tell, but underlying everything, it is the extreme price sensitivity of buyers to OCR projects. So the leasing market, well, we have been hearing that, you probably heard from HR people that number of EP holders, S-Pass holders have been diminishing. It's very hard to get EP even for new overseas nationals to come in, employment pass it is. And even for EP, some of them may not get it renewed. But we are only hearing one side of the story. The real thing is the actual fact of the matter is that leasing transactions are still going up. Net, there's still an inflow of overseas nationals here. And this is private leasing transactions. They are not likely to be construction workers. So they are not your shipyard workers. They'll be staying in the dorms. So the EP holders, which earn 3,003 and above a month, they are coming in, net. And on top of that, there are a lot of Singaporeans also leasing. They sold their flat. Some have tried to short the market, time the market, sell their private property, lease, and wait for it to come off first. Well, I'll show you something, a chart later, that this is not a wise thing to do. Okay. So the leasing market-wise, for prime property, this is prime. It's been dipping down. It's been very soft since 2 years ago. So the outlook, what's the outlook? Well, I think the outlook is dictated by certain government views, you see. And it's the view of the government rather than the view of the market. So the official view is that if you relax on the cooling measures, it will lead to upswing in demand, and that will lead on to a rise in prices. Then there's a third view, which is property prices have gone up by 60% and it has fallen by just 3.3% in the last 3 quarters. So implicitly, the intention is for prices to come off. That this implicit thing is from top down. It's a government view that it should come down. So I've broken down resale prices. As I said, I only use resale. I cannot use new sale because I cannot tell from the database whether it is net or rebate. For these 4 regions, island-wide, then broken down to CCR, RCR, and OCR, and then I further break it down for each region, the overall sales price, resale price, for those less than 70 square meter and those greater than 70 square meter. And we find that there are 12 sub-indices that you can get from this breakdown. The number of indices that went down quarter on quarter, that means second Q versus first Q, out of the 12, 8 went down, all right? 8 went down, but then on the other hand, you can see that 4 still went up. Now, we don't bother about whether it's RCR, OCR, which is a good deal, bad deal, or where, but we just look at the stats. The statistics show that it is not conclusive that prices went down across the board, quarter on quarter. There's still pockets of resistance put up in the market. So what it means is that there is still a possibility, the market is fighting back. The market is still very strong. Underlying demand is still there. Sales volume has come off, but balance sheets of developers, balance sheets of households are still pretty strong. And, but safe to say, I think this year we will see transaction volumes in the new sale market about 8,000, maybe 8,000 units, and next year also 8,000, partly because the decline in the government land sales program will be flowing through next year, the number of units that will be launched, and also because of the slowdown in developers phasing out their launches, and also the sales rate also have been slow. So this will bring us back to, in terms of new sale volume, transactions back to the period like, you know, during the SARS period days and during the 90s. The problem now is that there are a lot of people who think that prices should drop 10 to 15%. Only the problem now is that, you know, prices have been resisting. It has only come off like 1 to 3% in 1 year, 3% in a year. So how long do you have to wait for 10% or 15%? 3 years. I think it's ridiculous, right? So, but, you know, why I think the measures, why I think some of these measures I have issues with, because it is influencing demand and supply in different ways. It's influencing demand in the way that real estate prices in the long run, I'll show you this, right? Real estate prices in the long run have been trending up at 2.9% per annum since 1990. CPI, Consumer Price Index, is 1.9%. So that 1% is, we call the illiquidity premium, real estate being illiquid. So that's the trend line up. To force the market to come down would mean one thing: you're working against this long-term trend line. So to force it down, you create another problem. Just like when prices rose too fast, you create this problem called misallocation of resources, in the sense that funds are flowing outside of Singapore to buy overseas real estate. Right? So today, our deposit base, after the implementation of TDSR, the deposit growth has been falling faster than loans growth. Concern was loans growth. But post-TDSR, we find that the deposit base has been, Sing dollar deposit growth has been slowing, and the last 2 months has been negative. So what it means is, do we have these measures, but there's no capital control because we are a free market. Money flows out of Singapore. So it leads to other problems too. So running short of time. So the other thing is the argument of interest rates rising. Well, this chart shows you the relationship between interest rate and real estate prices. Generally speaking, before global financial crisis, the relationship is positive. Interest rates rise because there's general economic growth, strong economic activity, and that is good, right? Your salaries go up, jobs are created. That's why interest rates rise, property prices also rise. And the argument then interest rates rise They didn't say, nobody said that prices will fall, but it means that people may not afford the implied. So you try to you draw conclusions. But not necessarily so. If interest rates rise, because if you see a resumption of normal economic activity in the West, then it's good for us. Asia is extremely sensitive to US growth. But if it's interest rates, if US is not growing and there's still surplus capacity in the US, commodity prices are still low, interest rates are likely to remain low. You weigh these two things together, this interest rate argument should be thrown out the window. It's an argument that is, what if I struck Toto? What if I did this? Or it's not likely to pan out this way. Right? The chart shows generally is positive because if there's a resumption of normal economic activity, jobs will be created, salaries will go up. So the argument then also comes to this point that there's oversupply. Well, some quarters, I think particularly the property stock analysts like to use this oversupply argument. Their basis is that when they propound their hypothesis as oversupply was, at that point in time, the Singapore residential market is in equilibrium. That means demand and supply is well matched. And moving forward, the supply is going to be so great that it will cause the market to come off. Vacancies will shoot up. Yes, vacancies will go up, I agree. Vacancies, in fact, I think will go up from 7.1% to double digit for private residential properties. But the fact of the matter was that over the past 5, 6 years or 10 years, the market has been severely undersupplied. So the supply is coming out to cover the bridge the deficit. So there is no great disequilibrium. Why vacancies rates will rise is because, first of all, there is a slowdown in the general economic activity in the West. Right? So the high-paying expatriates are not coming in the kind of numbers that you wish. And the supply is coming on stream faster than families who are probably cramped up together can disaggregate from their own homes. Now, this includes HDB too, right? It's not just pure private. So overall, from the top down, market is generally quite healthy. Just that in the short term, there's some vulnerabilities because vacancies will increase. As it takes a while for more projects are completing faster that you can move in or find a tenant, right? Or you want to, by the time you negotiate to break up with your family unit, your parents, you take a while too. So RSI-wise, relative strength index-wise, it is not overbought, right? I don't think from the technical point of view, there's not a bubble. Here's a chart that shows you that those who think that they could short the market and then go and buy back again. You see, the general upcycle has been 17.6 quarters before from bottom to top. The last, from bottom to top, the turning point in the URA price index is exactly 17Q. It's around the same as the average. But the average, the downturn is only 8.4 quarters. And today we are 3 quarters into a downturn. This man-made downturn. Previously it was all created because of market forces. Average return in upside is 156.2% in Sing dollar terms. The downturn is only 25%. So you try to short your home, you buy back again, you get it wrong. Around this 17.6 quarters has a wide variation. You get it wrong, you'll be out of the market. So just imagine this, you have sold your home during the global financial crisis and you waited to buy back again. In the OCR, did it come down that much? No, I think you're out of money. You may have sold at $700, $800 per square foot. Now you try to come back into the market, it's $1,000 per square foot. So that's a lesson. Don't try to short your own home in Singapore. You get it right once, you get it right twice, you can boast about it, but generally that's not a wise thing to do. So in the short term, I think the demand will still be the smaller format homes. Right? Developers will still try to keep prices firm for the OCR and RCR because the land cost is high. Their land cost is high. And we are not in a market where we have a crisis, so why should developers lower prices? And in a crisis, you notice in the past, developers just stop selling. Right? So the CCR is where probably you can get good deals because the luxury segment is under a lot of tremendous pressure for both in the resale market and also in the developer sale market. So longer term wise, the market is still going to trend up. And I don't think interest rates were going to be rising very significantly. Probably managed up, but not rising significantly. So nevertheless, we think that for prime areas, prices will still dip by about 3 to 5% this year and next year. Same for rents. For the new sale, now qualified, things are getting very complicated now because of these measures. The new sale, less than 90 square meter apartment, I think it will probably be like this. In the mid-tier, I focus mainly on the mid-tier, this year will be flat. Mass market will down about 1%. Next year, there will be greater latitude for developers to lower prices because recently, since the start of this year, developers have been reacting to the measures by bidding lower and lower for the land prices. So what you're seeing now, actually, land that they won from the government in 2012, 2013, before TDSR. But after TDSR, developers have been reacting by bidding lower and lower. So it gives them a buffer to move prices down marginally. They may be 10% cheaper in land price, but not necessarily they have a lower price by say, since land is 60% of total development cost, it doesn't mean that it will lower prices by 6%. But I think they will try to have some latitude, moving it down by 1-2%. So that ends my presentation. Thank you.